All right, welcome to the Trading Homework broadcast. Today is February 13th, 2021, and got a lot to talk about. So it's been, I guess, about a week since I did one of these, and so much has happened. One of the first things I want to talk about is silver. So I tweeted out an article. I'm going to pop the article up here. It's right here. And it says why the silver longs and Eric Sprott can defeat the silver shorts, an education in 4D chess. I don't know if that article is showing up. It might be that I'm trying to show it on the screen. It doesn't seem like it wants to show. Anyway, you can find my Twitter and get the link there. It's Jon Tait on Twitter, JonTait. So the first thing I wanted to cover is I've got Hecla mining up, and we're going to talk about kind of a long-range campaign and how I'm going to be managing the position in Hecla mining. And as the price changes over time, how I'll be handling it is going to be different. So let's see if I can get a chart up. Okay. Looks like that chart is showing. I'm going to make it bigger for everyone to see. Okay. So here's the chart for Hecla mining. It's trading around $6 a share. It's up from a low in 2020 around $1.40 a share in March. So it's already up a ton. And it's been basing for a long time, really since August. And so there's a lot of pressure built up here. It had this big breakout a little over a week ago, where it shot up as high as $8.45, a huge move. And it retraced it along with silver itself. So if we look at SLV, it also had this big pop up to almost 28, big volume there. Let me make these bars wider so that they're easier to see for people watching this. I don't know, everyone probably has different levels of quality. So, okay, bar's much bigger now. So what happened here is this was on the tail end of the GameStop frenzy, and people were thinking that silver was going to be next, like it was all going to happen all at once. And if you it didn't move fast, then you'd miss the whole thing. And that's not really how this is going to have to work. Here's the reason. A lot of people don't realize this, but people who hold these precious metals, they don't just hold silver. A lot of them have gold too. And so if we look at this bar here, which interestingly is the very beginning of February, let's look at GLD. You'll see that gold didn't make the move with silver. So that was your first big red flag that that silver move may not stick. Because what can happen is people who have silver coins and bars and things, they may take those and go trade them for gold. So there's a gold to silver ratio. We can look at that here by doing gold to silver like that. And we can see that it is 66 right now. And it had been coming from a level of around 68 to 70 in that range at the time where silver had that breakout. And when it pushed that gold to silver ratio down to 63, which was lower than it had been in a very long time. And so what I think happened is a lot of people who had positions in silver traded them in for gold, and then now they're probably swapping them back into silver since the ratio fell back. So it's it's an island. You might call this an island in technical analysis, where it appeared outside of all of the various bands, and it gapped there and it didn't stick. So anyway, it looks like people who made that flipped out of their silver and into gold are kind of now flipping that gold back into silver, and they'll take their time to do it. So let's go back to Hecla Mining. So I'm not saying that this is the best miner or anything. I also have a position in AG, which is First Majestic. This is maybe kind of a better chart. I don't know. I mean, they're both pretty good. So let's talk about a campaign here in silver. So I mentioned in an earlier video why I like to buy the miners instead of like SLV. And I'm looking at the September contract for Hecla. And a week or two ago, the highest this options chain went was 11. And so I've been accumulating these. Every time I have profit on another trade, I go and just pick up some more of this little by little. And I may push it out, but the idea here is I want to be buying out of the money and with between 6 months and a year of time frame, and maybe closer to a year. So the reason is, if you look at what the contracts that are at the money or near the money are trading at, you can get 3 or 4 times as much out of the money. And if you give it enough time, sorry for the background noise. I'm not the only one in the house right now. Anyway, if you give it enough time, and you have reason to believe that the price of the underlying, in this case Hecla Mining, is going to rise. When I'm buying them this far out of the money, it's just like if it fizzles out, then I don't have to do anything with it. It's really expensive to roll it. If you look at the 11 strike and we go out to the next on the calendar, they don't even have an 11 here. But the point is, like, you're only going to get like half the contracts if you try to roll it, if that. So you can do that if it's not at the money with 3 to 6 months to go, then I might try to roll it. So the idea here is, as long as it's out of the money, I want to keep the time frame far away. And rolling is really your only choice. And so what you can do is, see how this one is bid 52, ask 63. These are just closing prices. The market's not open right now. This is a Saturday. And is it Saturday or is it Sunday? I don't even know. That's bad. Yeah, it's Saturday. So anyway, what you can do, you have some flexibility when you roll. You don't just have to roll into the same strike. So this is for 63 cents. Ask. I might get, I don't know, 55 cents or something if I try to sell these. And so what I can do is say, okay, well, how far does that 55 cents go here if I look at higher up strikes? And so it looks like I might be able to roll them into the 15s out here, which have more time on them. And the idea is, I don't just want to roll. If the price starts rising, I'm trying to time it so that it becomes at the money with about 6 months to go. Anywhere with 3 to 6 months, if it becomes at the money, then what I can do is convert that what was an out of the money position into a swoosh position. So let's talk about the swoosh position now, because I have one of those on First Majestic. I've talked about the swoosh position before, but let's talk about it again. I don't know exactly the one I have. I think it's this. So we're looking at the July contract. That's with between 3 and 6 months till expiration. If you want to buy a swoosh position, it looks like this. We're in strategy builder. We're going to buy, let's see here, at the money, well, it would be 18 in this case. And if you look at the price, it's $3.40. The reason that I build these as a swoosh position is, we'll explain that a little later. I don't like to just buy an unprotected call unless it's further out of the money, like I was explaining earlier. So I mean, this is a lot more capital to put at risk, and these things can really move hard against you. If you look at the chart for this, if you just buy this call, say you bought it up here, I mean, you'd be down 30% or something. I mean, this happens. This was is that big gap up? Let's zoom out on this a little bit. The hourly candles. Yeah, I mean, this is what can happen if you just buy these things without protection. You can lose half your money or more very easily. I don't like to do that, and so the reason I'm buying those further out of the money calls is I intend to convert it into a swoosh position if the trade works out. If the trade doesn't work out, it doesn't cost me much to buy more time by rolling it out, or just letting it expire. That's okay. So anyway, let's convert this into a swoosh. It's not a swoosh yet. We're going to look at 3 weeks. So we want more than 2 weeks of expiration on a put. We're going to buy a put to go along with this call, and we want the price of the put to be about a third, no more than a third of the price of the call we're buying. So we're looking for around $1, anywhere from like 90 cents to $1.25 on the put we're going to buy. So we come out here. A lot closer in on the calendar. We want to keep the put with at least 2 weeks till expiration. We keep rolling it. Hang on one second. Sorry about that. My kids needed a noise check. Anyway, okay, so the other thing about the put we're going to buy is that it's going to be slightly out of the money. I like to go about 10% out of the money. So it looks like we're buying the 18 call, then we can get this 16.5 put for about $1. That's the price range that I was talking about. So I didn't set this up ahead of time. That's typically what you'll find when you look at these on a market that's kind of calm. And silver right now has calmed down a lot since that big move. So the reason it's called a swoosh position is because when you look at it in the options simulator, you'll find, hang on a second. Sorry, I told them I was recording, but I guess they don't care. They're just being loud, having fun, being kids. So sorry for the noise. Anyway, yeah, it looks like a swoosh position, or a Nike swoosh. And the dotted line, like we don't want to let this get to expiration. So by constantly rolling that put, it's a small price as a part of the entire position. So this would cost about $4.25 for this entire thing. It costs more than the call. At least when you first put it on. But what happens is when this thing starts working, the value of the put drops pretty far. And I mean, I tend to keep rolling them. But what's nice is if the price moves down on you, let's look at this a little further in the calendar. So if we put this on, so this is, let's see what next Friday would be, because that's when I would need to be rolling the put. Next Friday is the 19th. So right here, if the price doesn't go anywhere, and it stays around, I don't know, 17 something where it is, we'll have lost a little bit of money per position. However, like, here's the nice thing. Like, if the price goes down, say the price falls 10 or 20%, well, then I still have all my, original capital, and I can reset the swoosh 20% lower. So I could essentially roll into a 14 call instead of the 18 I originally bought. So this price is the underlying says 13.93 right here, and I will have only lost $1.50. In reality, probably I'll have lost less than that, maybe even a gain, because if it goes down, then a lot of times the down move will happen fast, and the options premiums are higher. So anyway, the point here is I can roll into a 14 call and then 10% lower buy protection that's close in, with 2 to 4 weeks to go. Generally I want to put it on at about 3 weeks out and keep it no less than 2 weeks, because what happens is in the final 2 weeks you get into this region below the curved line here and above the solid line, and if you notice, like, that's where the bulk of the losses happen on this position. So if you let that put get too close to expiration, then you're going to find you're losing money fast, and you're not going to have protection either. Like, it won't protect you. If you try and build the same position with a put that only has a week to go, you'll find it doesn't protect you as well. At least that's been my experience. So it takes a much bigger drop to get protection, or for your protection to kick in, if you only have a week to go. If you have more than 2 weeks to go, then you've got a decent amount of protection. So if we zoom out on this, or zoom way out, that's too far. Let's look at it like that. Okay, so I'm almost always resetting these things before the fall gets crazy like this, where you're actually making more money on the put. The call's worthless. Really, the intention here with these is that call with really long duration, between 3 and 6 months, I'm wanting it to take over the value of the whole thing. Like, all the way up here in this region, the put isn't even really a factor at all, and you can let it drop or whatever. You may reset the swoosh higher up in order to both lock in gains and also to so that you have protection again. But you don't need to do that. Ideally, if your market rises steadily, then you can exercise, once the delta gets really close to 1, you can exercise the option and take possession of the shares. And so in the case of miners, I would look to move them out of a margin trading account and into a cash account somewhere else. And so that's kind of the full campaign in the miners. And so, I'm looking at pretty far out of the money calls with more than 6 months to go to get this started. These are like planting little seeds in the ground. And the idea is to grow that into a full crop. And when it's harvested, it gets exercised, converted to shares, and moved to a cash account. It's really kind of an interesting side note I want to mention when I talk about campaigns like this. For me, they're in a large part inspired by the guy who was a farmer in, I think it was the original Market Wizards book, or maybe it was no, it wasn't the original one. It was one of the sequels, I think. Gosh, what was his name? I can't believe it slipped in my mind. What a fantastic trader, though. That guy's story was crazy. All right, let's see. So we talked about swoosh position in the miners. One thing I haven't looked at is I made a watch list. I don't know if I want to get into that or not. Maybe we can look through the screener. That might be fun. So I think Monday's a holiday, President's Day. So we've got some extra time. I may do another broadcast before Monday. maybe let's talk about some highlights from last week. So things went crazy with the marijuana stocks, and I was in some of them. So I want to talk about Tilray. Tilray is probably something that people were trading last week that might be watching this. I was in Tilray. I got in before the craziness, and I actually got lucky, sold the top, or damn near the top, on the day of the big move higher, and which was, I think, Thursday. Tilray. I mean, it wasn't a huge position. I mean, it's just trying to spread my bets around a little better, and just as an effort to improve the consistency of my trading. So I'm going to bring up the chart for Tilray here, and I'm going to bring it up on stock charts. It looks like it was Wednesday was the crazy day. It's kind of a long week. It all kind of blurred together for me. So I'm going to put up the chart here. So yeah, I didn't quite sell the exact top. I think when I sold it was like 64 or something. But I'll show you the metrics I used. I didn't sell any of the other marijuana stocks I had. I had CGC, and I had ACB I featured last week on here. So I'm in ACB. What else? CGC. And then the other one I have is Cron. And so, they all kind of moved the same, but Tilray was by far the biggest mover. So here are the metrics I use for when a stock is oversold. And a lot of them might have met this criteria, but I mean, this one had moved just so much that. So here are the metrics. There's really just three that I mainly rely on, and it was already I keep saying oversold. I mean, overbought. We're going to talk about overbought metrics. So the RSI, look at how high the daily RSI was. It was like over 90, it looks like, on that day. And if you look at the weekly, it's 81 right now at the bottom of this like weekly bar. So the volume was bonkers, just off the chart crazy. So the RSI over 80 on the weekly and on the daily RSI over 80. So those two things, and then there's a third thing that I look for. And what it is the 50-day moving average, $15.86. That is so far extended above the 50-day moving average. Anything 90% higher is that's an extended stock. And so there are a lot of things that I could have done. What I could have done was, I talked about earlier about rolling up to take that takes profits. However, the problem is that the puts were really expensive, and so I didn't want to put on another swoosh position. What I did is I just sold out of the Tilray. I kept the other marijuana stocks. And what I did is, at the end of the very next day, I bought the position back at $33. I put on a brand new swoosh at $33. And then what happened is, at the end of the day, Friday, it was down by more than 10%. And so I got to, in the final minutes of the day on Friday, I reset the swoosh from 33 to 29 for free, basically. I mean, the increase in value of the protective put that I bought paid for me to roll the call that I had, the July call that I had, from a 33 down to a 29. And I, because the put I'm buying is cheaper, I basically used the profits from that protective put to reset this lower. So this is going to be a recurring theme. You guys are going to hear me talk about this kind of thing all the time. It may just keep sliding lower, and if it does, I mean, at least for now, I think what I had to do with the put, though, because the puts were so expensive. Yeah, here's what I had to do with the put. Let's look at Tilray. The put that I bought actually didn't have 3 weeks to go. Those were crazy expensive. Like, if we try to build a swoosh, like, let's build the exact swoosh that I'm talking about. So we're going to go to June expiration. I started with the 33, and I think what I had was a 30 put. Yeah. So, yeah, on February 19th. So remember those guidelines where I talked about, this is $10. So the protective put I'm buying, I don't want it to be more than $3.50. And so if you look at with 3 weeks out, 3 weeks to go, that's way more than $3.50. It's twice as expensive. So I had to do, there's a few different things you can do. What I ended up doing was coming in on the calendar. And so when I put that on, this had a week and a half to go, the 30 put. And it's more expensive now. When I got it, it was the right price. Like if you look at the chart for this one, look at a chart just for this put. And you'll see that, like, let me zoom in, not hourly, let's look at 15 minutes here. So when I bought it, when did I say, February 11th? When I bought it, I don't know, it was somewhere in here on February 11th. I don't remember the exact time. I think it was near the end of the day, but it might not have been. So I got in around 33. Actually, I think it was around the middle of the day. So anyway, where did that chart go? There. So anyway, yeah, here in the final minutes, you'll see that like that put shot up in value from around $3, which I think what I ended up paying. I think I paid around $3 for it. It was probably somewhere like around here where I put that on. The price advance in this put paid for me to get the cheaper call. So what I rolled into, and I because this is just the paper trader, I don't have a way to show you rolling. I don't have any positions on in this. I'm not using it for trading. I'm just using it to show you the options combos. So let's look at the position I rolled into. So this one is $13.43 for this position. So just remember that, like 13.5. And if we look at the one I rolled into, I'm gonna buy the 29 call. I think I got the 27 put, but yeah. I think that's what I got. The price of this one is what? Minimum investment. Yeah, see about $13. It's not saying it here, but oh, there it is. Yeah. So you can see that like this one's a little cheaper. However, what I should mention is that the put is a little closer to the call. I'm gonna have to roll this put next week, and as the implied volatility drops on this stock, you can see that it's over 200%. It's very high. As the implied volatility on this stock drops, then hopefully I'll be able to like push the put out further and further in the calendar faster until I've got it 3 weeks out like how I want to. Because that's how you get the best protection. Like if you look, like I can't really let this put go past Tuesday. If we play it forward here, I think this is Tuesday. Like it's eroding pretty quickly, and it's not giving me much protection as it gets closer and closer to expiration. I might be able to. Let me look ahead at how I might have to roll this. So 27 put for $2. So what I could do is roll it into a 26, and that won't cost me too much on Tuesday when I do this roll. That's probably what I'll end up doing. Because if I clear off this leg and I look at it with the 26 put, that's still about 10% away, and it'll have more time on it. So yeah, when it re-renders. It's not giving me a ton of protection. So, yeah, I mean, implied volatility in this stuff is so high. Or I may just close out the whole thing. I mean, I don't know if I want to be in Tilray. This is just it's such a huge decline that, I mean, I don't know how much more upside is left here. I mean, that might have been the big flush right there. It's hard to say. If it was, then it's just dead money for me to sit around and try and, I mean, you know, I need these stocks basically to go up or crash. But if they crash, I need to cash them out. So, I mean, this looks a lot healthier, CGC, just because it looks like it didn't really blow off. Like, this looks like just kind of maybe a normal pullback that you might see as the stock goes into a base. The volume isn't nuts or anything on the drop. I mean, this one looks so much healthier. Yeah, I mean, it's a crappy candle, but it's just one candle, so I'm not as worried about CGC. So I don't know what'll happen with Tilray, but what I could do is maybe try and do some credit spreads and make money off of a drop in this implied volatility. But I don't know. That's not really my style. I tend to stay away from that kind of stuff. All right, so we talked about the marijuana stocks. Oh, there was something I bought. We can talk about some stocks that are in bases. One of them is Neo. This is a really popular stock with traders right now. One thing I don't like about it is it's a Chinese stock, but I tend to stay away from those. But this base is so nice that, I mean, I am not going to turn my nose up at an opportunity to make some money. So I took a position in Neo, and what I did, I actually did this a few ways. When I first thought it was really going to rip right here, I didn't know that it would make this little handle here. But I guess the first tell was that the volume wasn't really big right here. And so it came up and it kind of hit this upper Bollinger Band and stalled out without clearing this high back here at 67. So as of now, it still looks pretty good. Tesla, well, let's not talk about Tesla yet. That's a whole separate topic. So the first way that I was playing Neo, let me come in here and we'll look at Neo options. All right. So the first thing that I did was, and this kind of ran out of time, so I'll show you this technique. I may have covered this on the show a week or two ago. I don't know, but I typically like to run these starting on a Monday or a Tuesday with about 2 weeks to go. So I'd be looking at putting on something like this on Tuesday and maybe seeing how it ran for the week and probably not try to hold it till expiration. So this really works with liquid stocks or stocks with a liquid options market, and it's best when they're higher priced. So Neo is not high priced, but the technique can still work. So we're looking at $60 right now is the share price. I'm seeing that up here. And so what I'm going to do is use we're going to sell an option, and we're going to, let's look at it like this. I'm going to sell a 56, I'm going to buy at the money a 60, and then now what happens here is we've got, when the market's trading, it's really nice. It tells you right here the price of it. Oh, here it is. Okay. So we've got a $2 credit right now. And, this is not a bullish position right now. If you look at it, this makes money when the stock drops. But we're going to convert this into a bullish position because we're going to take that $2 credit and we're going to use it to buy one or more calls. The other thing about it that I'm going to point out is this has a margin impact of $400. It costs $400 to put this trade on. And depending on what options we buy, if we only use the credit we have, then it doesn't change the price of this trade. And that's really the point of it. So, and this $400 margin impact, I know exactly what that is. Here's what it is. It comes from because I'm selling a 56 call. I'm on the hook for any price gains that might happen up to the 60. So the 60 now kind of cuts off my what would be losses. So now let's turn into a bullish position. Let's start by buying 270 calls. This is not exactly what I had. This makes it now a very bullish trade. And if you notice, like the minimum investment, it doesn't change here. This is telling me I get an $85 credit for this. See that it's minus $1.15. There's still credit there. So maybe let's drop this down to a maybe buy 268s. I want to try and spend all that credit. Oh, because this is only one. Yeah. So you could do this with one option or you can do it with two. If you do it with two, it's more aggressive. It also will have more time decay. See here. So yeah, this is no longer a credit. All right. All right. Let's keep it at 69 there. So here's the way that this works. Actually, I like it better at 70. Sorry. Let me change this one more time, and then we'll talk about it. Okay. So now it's a credit, and you can see that kind of the launch off point for the trade happens if the price goes above 60, and you're going to be on this dotted line, but the dotted line is going to be falling closer in towards the solid line over time. This has about 2 weeks to go. So if I start playing this out and walking it forward one day at a time, you'll see that, like, if the price falls, then the trade doesn't lose much. It loses very little. If I were to just outright buy these 70 calls, if I bought two of them, I could lose $200. But by buying two of them this way, you can see that if the price drops, it doesn't take my money away. The only way I lose money really is time decay. And so that's a reason why you might want to structure an options trade this way. And you can see that, like, if NEO really takes off, for putting down $400, I can make 10 times the money, and like I'm really just paying time decay for the chance to do that. And so what that means is, if I put this on Tuesday, I may be using slightly different prices here, and you can restructure this a whole bunch of different ways, right? So this is called a back spread, by the way. It's really a ratio back spread. So the reason I like to put these on Monday or Tuesday, in this case Tuesday, because there's no trading on Monday, is because if the stock just takes off and runs for 2 weeks, I mean, you could see NEO go from 60 to 90, and when that happens, you're going to know pretty quick if it's going to happen. And then really the only risk that you've got, and you can do some follow up to mitigate this risk, but if it runs up and then falls right back down, you might find yourself, with eating all that time decay all at once. So you can get hurt on these. But if I wanted to structure it with only $200 of risk, I could do that. But so anyway, you can take a look at this and compare it to just buying the calls, the out of the money calls, and see which one you like better. This is a fairly complicated combo. It does have a higher transaction cost. If you look, the commission here is $6. Don't pay attention to this commission percentage on this one because that's going to be misleading. You're really putting up $400. So what is $6 for out of 400? Look, it's not that much. So you're allocating $400 of your capital into a position like this. But you've got to transact across 3 different strikes for 4 options for each one of these positions you put on. So like you can up the quantity here. You can put in like 10 of them if if that's what you want to do. And now it's $4,000 for this example. And you'll see that if you bought 10 of those, here's what it looks like. So that's pretty decent money. You can play it forward and see how much you lose. You lose $1,000 if it didn't go anywhere by February 16th. That's for $4,000 of margin. I like the higher price stocks better because they're stocks like Tesla. We'll look at Tesla next. They're so much easier to get in and out of, and the commission is such a tiny percentage on the trade. So there's a lot going on with Tesla right now. That's kind of interesting. That might be fun to do a walkthrough on. So let me close this out. I think. I didn't talk about the other way that I was playing NEO. So I may put a trade like this on NEO on Tuesday and see how it goes in the beginning of the week. And if it doesn't take off and break out from that base, then I'll just close out of it. So the other way that I'm doing is I have a swoosh position in NEO. So let's take a look at that. And so the more I build these, the more that it's going to become really obvious the methodology behind it, and you can quickly build these on your own. I think I might have August. I don't know. It doesn't matter what I have. Like we'll just look at one as an example. So we're looking at buying a call with 3 to 6 months of time on it, and we want this to be an at the money call. So it's around 60. So let's go with the 60 call here. It's the price is around $16. So I'm going to be looking for a $4 or $5 put with about 3 weeks to go on it. And typically you'll find those about 10% lower. So right here, the 54, that's about 10% lower. And the reason I can predict these numbers is because the implied volatility is not like, this is a calm stock. This is what it looks like when the stock is calm. That's why I like to put these on when stocks are in bases. And so we're going to go find some stocks that are in bases. So I have the range cranked up pretty big on this, but you can see what that looks like. And this is per, this is for 10 of them. So let's look at it just for one of them. So for one, so here's the difference. Instead of putting up $400, we're putting up almost $2,000 for one quantity on these. However, the price of carrying this one is just rolling the put. So as long as I still want to carry this position, I keep that put. I keep rolling this put so that it's got more than 2 weeks of duration on it. And that gets cheaper and cheaper as if the stock takes off and the put goes from $3 down to 30 cents. Then it doesn't cost you hardly anything, and you may not want to even have that put, or you may roll the call up and get a protective put or something like that. I mean, there's all kinds of ways to manage the trade after it takes off, if it does. So if NEO moves 100% in, I don't know, let's look at, well, it's not going to do it probably in 3 weeks, but it's telling me I can't look further out because the closest expiration in the combo is the put with 3 weeks to go. It doesn't really matter though, because you can see this line is so, like, it's so close. Even if we looked at it like today, it doesn't really matter up here. So this is a position that can really grow. You're putting up $2,000, and you can, if the stock doubles, and stocks double all the time in 3 to 6 months, then this has made a lot more money than just buying shares. It's also got a lot less downside than just buying shares. You could buy shares on margin and buy a protective put. That's another way to do this. But you get a lot of juice for doing it with the call. So like if we were to buy the shares on margin, it would cost us $3,000, and we're getting this whole, and that doesn't even include if we were doing it for 100 shares. If you bought 100 shares at $60 and you did it on 2-to-1 margin, it would be $3,000, and then you'd still have to buy the protection. So it's a lot cheaper to do it this way. If NEO was not already up so much, and it was instead maybe in a state like this where we wanted to make some long range plans, then if you think back to what we spoke about in the beginning of the video, what we might do instead of starting with the swoosh position is go further out in the calendar and buy out of the money without protection, without the protective put. So like if we look out instead of 3 to 6 months to go, if we look out like between 6 months and a year to go, so we look all the way out here and we go out of the money, just to put it in context, like looks like as high as it goes is 100. It's going to have some serious time decay, but if you wanted to, you could, so instead of putting down 1,800 like we were looking at, you could buy some deep out of the money call, and when the price got to 100, you could convert it into let the time come in on it, so it's got that 3 to 6 months to go, and you could even roll it in if the price got there sooner. So if the price got to 100 in 2 or 3 months, what you could do is you could roll in on the calendar this January 21 to August, and what would happen there is you'd get it for cheaper. See that? So we put down $11 for the contract, so $1,100. We put down $1,100. If the price zoomed to 100 in a month, the prices of these calls would change. But the point is, like, this one is almost half the price, so it's like 2/3 of the price. And so when you roll in, you'd be taking a profit, and you could take some of that profit and go and buy the protective put. And now you're in a swoosh position, and those are, for me, really comfortable to sit in. I like sitting in calls that way, because the downside is protected. If it ran up to 100, you might be worried about it sliding back down. Well, if you just kept that further out call, if the price slid back down, then you're going to be losing a lot of money. But if you convert it into the swoosh position and it falls back down, then you can reset the swoosh at lower and lower prices. And so you can essentially set the basis of your call much lower. So if you have the time to do some long range planning, then you can get into a position for even cheaper if the price comes to you. And if it doesn't, then you've lost some money. Maybe you sell it just for the time value if you don't think that it's going to happen. You might lose half your money that way, but I mean, there's no matter how you slice it, there's risk, at least for every way that I know how to trade. All right, I said we would look at Tesla. So let's look at Tesla. I zoomed in on this the other day during one of these broadcasts, one of these trading homework broadcasts. It was hourly bars. Maybe not. What were we looking at? Yeah, there we go. Now you can see it. So this looks like a flat base on the daily chart, but when I zoom in here, this is kind of like a really bad technical thing that happened right here on January, it looks like 25th, where the price, it broke out above the old high at the beginning of what would be this flat base of 884. It hit 900. Then it came back down, and it has not been able to get back up there over the 890 mark since. And so this, to me, it's like, even though when you zoom out and you look at it on the daily chart, it looks bullish. Like this was kind of like a technical damage that happened here on Tesla at 900 in the end of January. So that's one reason why I've been playing the long side and the short side of Tesla. The other thing is, if Tesla does go down, like it could take the market down. I mean, it could put a lot of pressure on the NASDAQ and the S&P 500. So let's look at the daily. Yeah, it's kind of visible here too, but it looks more like a flat base. Now it kind of looks like it's rolling over, but there's a nice hammer on Friday. So, and plus there's the 50-day moving average. The reason I didn't really do much with Tesla on Friday, or really like I didn't do much late in the week with Tesla, is because the 50-day moving average is at 750. And so if you get like really short dated out of the money puts, yeah, they're cheap, but there's the 50-day moving average right there. So it's really kind of trapped in this limbo between the 21-day, which is at 825. The price is at 816 right now. And it's trapped between the 50-day moving average at 750 and the 21-day moving average at 825. So while it's in that region, I'm probably not going to be doing a whole lot other than watching like tactically for opportunities where I can, if it looks like there's a chance it might break out of that range and I can get really cheap options, then I may jump in and do that. Let's take a minute though, and let's look at. Hang on one second. I'm gonna organize my windows here. Okay, so let's take a minute and look at Tesla combos. So Tesla doesn't have earnings coming up right now. Those were a week or two ago. I think it was 2 weeks ago. So here's Tesla, and let's look at the back spread or back ratio spread on Tesla, and you'll see what I mean about like this thing is so liquid. So where's that now? What did I say? 817. So if I'll show you how to build one of these with a pretty cheap margin. So with 2 weeks to go, if we sell in 800, buy in 820. Let's get this up in the profile here. So you can see that the margin impact is $2,000 for this. And now what we're going to do is we're going to go shopping. So we've got about $10 we can spend on calls here. And the implied volatility of Tesla is dropped down quite a bit because the earnings aren't there, and it's been in a range for a while. So that I like how cheap the options are. Looks like we could get a 890 call. The other thing we could do is if we go a little further down, we could get two 935 calls. Let's try it like that. It would take a big move in Tesla in a short time to do this. But if you're really bullish on Tesla, here's a way that you can put up $2,000, and if you don't hold this for more than a week, if it's not working, it's probably not going to lose too much money. So it will lose on time decay. So you can see there. The other thing is with these back spread or back ratio spreads, if the implied volatility drops, then that can also really hurt the value of this. So that's something to be aware of. Like if you put one of these on heading into earnings, after earnings, like even if the stock moves your way, you could still lose so much on the IV crush. So it's just something to be aware of if you look at doing these. So for posting $2,000 per position, you know, if Tesla moves to 1,000, you can make a lot of money. The other ways to do it is you can just buy same week calls and hope that those hit. I mean, you know, you can compare this to a lot of other ways that you might like to do it. But again, the reason I put on trades like this is because if the price drops, the value of the call that I've sold short is going to drop. And so that helps pay for the losses that I'm incurring on the options that I'm long. The reason that you see me put an option down, like I sell one and then I buy one, because it sets this margin impact. The distance there, if you make this wider, you can buy calls that are closer because you have more money to do it. So, I mean, you can move this all around however you like. I'm just showing you some ways that I like to do it. I don't know that I'm going to put this one on. Well, let's look at it with, instead of buying two of the 935s, let's just buy one more expensive call. So it looks like we could buy the 890. Yeah, and it looks like that turns it into a very small debit, but that's okay. Depending on where you fill, it may not. All right, so I just want to age this a little bit and look at it in the simulator. So if I hold it only till February 17th, and again, like when the market opens on Tuesday, this is all going to be different. So I'm just trying to get a feel for where prices might be, what levels, what combos I might want to put on. If I just hold it for a few days, I might lose $500 if the price doesn't go anywhere. In 2 weeks' time, Tesla can move 20 to 30%. So these kind of gains are possible. So that's kind of what I'm looking at on Tesla right now. These options are a little expensive. What that means is I have to go out pretty far before there's a call I can buy. A few other things that I'll do is as you get closer to expiration in the same week, I might put on something real cheap. Like I think one of the ones that I talked about last week was a 950, 1,000 bull call spread that didn't have hardly any time left on it. So this one, it's got a 28 to 1 return to risk. That seems pretty good. It's kind of expensive though, $174. If the price falls at all, this will get a lot cheaper. So it looks like it's a really cheap thing, but I mean the odds of this hitting are just so low. You kind of need a catalyst. So I put on one of these for really cheap. I think I paid, I don't know, $50 or something for one last week, and it just fizzled out. But I mean, it had a risk to return ratio that was way higher, but also like very low likelihood of happening. These kind of trades can really burn your account balance down if you're not watching them carefully. So, I mean, at the end of the day, it's important to be in stuff that's moving. What are some other trades? I had some really cool trades. Oh, I haven't even talked about Riot at all on this show. So let's look at the Riot chart. I'm in this one. I've been in it for a while. I can walk through what trade I put on in Riot. So first of all, it's Riot blockchain. This is a Bitcoin play. I want to show you the ratio chart with over the GBTC. And you'll see that Riot is outrunning the Grayscale Bitcoin Trust. My guess about why that is, for a few reasons, is one, I think Riot can mine anything they want. They don't have to mine Bitcoin. So if Bitcoin's underperforming, they could probably switch over and mine something else. I don't know that they just mine. They've got other legs to their business too, I think. I'm not sure. I think, is this one? No, this is a marijuana stock. There's a few more of them. Oh, here's another one. Marathon Patent Group. So this one actually is outperforming Riot. I think it's called Marathon Patent Group, and when I first saw that, I thought, oh, patents, ew. I don't like that. But if you read about what they do, they're actually a Bitcoin miner, and so what they're I think what they're doing is they're not just mining Bitcoin. I think they can mine other things, but they probably started their life as like a patent portfolio, and they're like, well, hey, we're holding all these patents. Like, why not hold cryptocurrencies too? And so I'm just guessing that might be their backstory, but I think this was actually outperforming Riot at times. Yeah, so I like to look at these ratio charts. It's a good way to race stocks off against each other. Yeah, it looks like they're moving pretty similar. So I'm not sure that you need to be in either one. If you're wanting to express a view on Bitcoin, it may be that they're fine substitutes, but sometimes what happens is one of these stocks will run ahead of the others. Like we saw that with Tilray in the marijuana stocks. Like just owning marijuana stocks wasn't good enough. Like if you were lucky or smart and you were in Tilray, you got outperformance at least until it dropped 48% in a single day. So I don't know that these things are gonna one will start outrunning another. But there's another one that people are talking about. As we're just going through these, you may as well talk about this one too. It's MicroStrategy. So they're up a lot because they're, I guess, they're borrowing money to buy Bitcoin, which it might be great on the way up, but on the way down it could be really bad. So let's race Riot against MicroStrategy. So I found MicroStrategy first. That was the first one of these to hit my radar. And then when I found Riot, it was right around here after this big run up to 30. And I didn't buy any at 30. What happened is, after it had fallen back, and it was around 22, I put on a swoosh position in it. And then I reset the swoosh position lower to 18 after this drop. And so I've been in Riot with a swoosh position starting at 18 and just rode it all the way up. I still have it. I haven't even done anything with it as far as like doing any rolling other than rolling the protective put, which is like really just dirt cheap right now. So just to give you an idea what that swoosh position looks like, I'll show you the chart of it right now. Let's go ahead and draw that. So the reason I'm talking about Riot is because it does have a liquid options market. And so this is really what I have found to be the best way to express a view on Bitcoin for me. Like I don't buy Bitcoin. I haven't bought Bitcoin or any cryptocurrencies, but I have taken a position in Riot, and we're gonna look at it right now. And it's easy for me to say it after the fact. Like, you don't have to believe me. I don't care, but I just want to show you like how this has worked for me, so that maybe that might be helpful for you to see, in case it's something that you see an opportunity to do something similar in the future. I mean, I obviously don't call out all of my trades before I do them. Sometimes I find the idea in the middle of the day and then put it on, and I don't. I don't tweet every trade or put every trade on YouTube. All right, so here's what I have, and this no longer has protection. That really is worth anything. I think I rolled from a 16 to a 17 put or something. Like, I'm not even rolling the 16 strike anymore, which is what I had. So here's the position. I added it to quote panel so you can see it up here now. And we can look at the performance profile in the simulator. And I have to zoom way out here, and you can see what it's doing. So like when I got it, it was right down there. So it's got quite a bit of profits on it right now. It has risen so much faster than the share price itself. So the share price is a little more than double where I got in. So if you recall, when I first was looking at this, the price was 22.5. And the price right now is 49. So had I just bought shares, I'd be up a little bit more than double. But this position is, let's see here, is that going to give me a quote on it? Well, let's look at it on the chart. So my cost on this is around 9, and right now it's like 30 something. So it's more than a triple at this point. Now, I mean, that could change any time. I mean, Bitcoin could go down, and I could just, it'll surrender all these profits for me. And I don't really think that's going to happen. What I'm seeing is I'm seeing a lot of companies that want to move their assets into Bitcoin, and so what I view as going on right now is this is a shift out of the dollar by the corporations aren't going to wait around. They're going to do it on their own, moving away from the dollar and into things like Bitcoin. So. This is the way that I'm expressing a view on Bitcoin. It started off as a really small position. It was, I put just a tiny amount in it, and it has turned into a much bigger thing now. What I'll probably do is I might just hang on to it until the delta gets real close to 1, and then exercise the calls. And move them out of the trading account maybe, or I might just leave them in there to give margin. Not sure yet, but I like this one as a hold right now for me. I would not be getting into this same position. This is buying into this is not the way to do it right now. I wouldn't put that on. I don't give financial advice on this show, so that's not what this is. All right, let's see here. We talked about Riot. Let's go over to Finbiz and see if we can find anything interesting. And it's so full of ads. I was talking about subscribing to this thing just so that I don't have the ads popping up all the time. Let me make the font bigger. I don't know if everyone can read that all right. I hope so. Okay. So first I'm going to take a look at crypto, maybe after I look at an ad. All right, yeah, not really doing much. Over to the screener. So I'm going to just be looking at optional stuff. I want optional and shortable. Man, these ads are so bad, guys. Sorry for that. I need to get subscribed to this thing, or premium, or whatever. Hide. Is that really going to hide it? Oh, lucky us. All right. Make this window a little bigger. But it just keep coming up. All right. What do we want to sort on? Or let's add some more filters here. Maybe we'll try and find some things that are in a base. I love to get into things that are basing. Sometimes I have luck with these patterns, but we did that last time. I didn't really see anything interesting. So let's look at maybe stocks that are 10% or more below high. No. Here we go. 0 to 10% below high. That's probably not going to filter out a whole lot. Gosh. Yeah, still a ton of pages. So now I also want stocks that, let's look at ones that are maybe not really done a whole lot for the year, or maybe 6 months. Half, let's see here, up. Yeah, sure, up 10%. And the thing I don't like is that it has this plus. So, I mean, like any stocks that are up 10%, I mean, that's going to be like the whole list. Yeah, that didn't really filter out much. I'm trying to think if maybe close to its 50-day simple moving average would be a good thing to look at. I'm just going to take this one off. I don't want that on there. Okay, 50-day price. How about that? Let's do a sort here. How many pages do we have? So 8 pages. That's not too bad. Let's get a sort on there and then look at the charts. I want to sort by volume. All right. Let's flip over to the charts view. Yeah, this is about this. Price 10% below 50-day. So here's the problem with what happened is it's showing me all these stocks that are up, and I want stocks that are sideways. It's like a little tougher to screen for that on here, actually. maybe let's look at ones that are. Is there any below their 200-day moving averages? 3. None of those 3 look interesting to me. All right. So we'll keep that. How many pages do we have? Probably it's a ton. 37 pages. We need to narrow this down. Beta. A buddy of mine, I was watching him use the screener, and he did something really cool. He looked at, I think he did a price to sales screen here. This could be good. Let's do a earnings per share growth this year. Hi. AMD. I have a swoosh position in AMD. How many pages is what I'm looking at? 10 pages. Okay. Well, Peloton's kind of basing there a little bit. To me, that's kind of a coronavirus lockdown stock. I don't know that I'm too crazy about that one right now, but I mean, it might go up a lot. I don't know. PayPal's moving, I think, because they've got some kind of a cryptocurrency thing going on right now. So PayPal has been on my radar. It's kind of a slower mover, though. It's not really in the most actives. I have a most actives list that is pretty good. Maybe we'll go over that later in the weekend. I don't want to go over that now. I'm trying to do some discovery right now. Ford is moving. All these auto companies are moving. Oh, we should talk about CCIV. Let me get the chart of that one up. I got into CCIV. I did want to talk about this trade. I got in on Friday. It's been on my radar for a while because it's been on the most active lists. This is a SPAC, which, I'm not really crazy about that. And that's one reason I was avoiding it, but the chart is just too strong for me to walk away from it. So here's the chart for CCIV. I got in on Friday. Near the end of the day, too. So, I mean, maybe I bought the top. I kind of doubt it. This is one of the strongest charts I have seen in a very long time. Just look at this explosive volume. And it's like making these Nicholas Darvis boxes. And so it just broke out of a Nicholas Darvis box, which is why I got in. The position I put on, it doesn't have weekly options. CCIV only has monthly options, that's really the main reason I avoided it. I first was looking at it here, and I almost bought some on this little dip, but I didn't. And if I did, man, I would have been much better off. But I didn't find a good way to do it until I got really creative on Friday. So let's look at CCIV, and I'm going to talk you through what I remember doing. Again, I don't know if this is exactly the position I have, but let's just go through it together. In just a second, I'll build a combo there. Okay. So what I did is I went further out. I went to August, and I said, at the money, let's call it 40. Here goes a strategy builder here. And so now what I need is $4 or $5 of protection and normally that would be with 3 weeks to go. Well, it only has monthly options. February 19th is too close for me. 6 days away, 1 week. So how am I going to protect a position in August by buying puts with 6 days to go? That's not really realistic. So what I did is I went out here to March 19th, and I ended up not buying a 35 put, because if you look, that's too expensive. What we're protecting is a $17 call. 9 is too expensive. I could have went with the 30, maybe. I mean, this might work. It's really far away though, so when you look at this, I didn't really like the way that looked. Like, it just, if the price falls, you're really getting hurt. It doesn't give you a whole lot of protection. So what I ended up doing is something that's maybe a little higher theta, but I'm hoping that it won't matter. I think I ended up buying 2 of these 25 puts. And if you notice, like, this actually has some protection if the price drops. But if you play it forward in time, because it's a little further out on the calendar, it still doesn't have too bad of a time decay. So the position that I'm in here, I really need CCIV to go up quickly, because what'll happen is, if it stays around 39, I'll be fine for a week on these puts. Like, this decay isn't gonna really hurt that bad. But if we go out, if we start to get into March, I need to figure out a different way to get protection on this, or else maybe close the position if it's not going anywhere. So if you notice, like, so by the time we get to March, this trade idea either needs to really be working, and I'm not going to care about the, like, if it's up here, I don't care about the puts, because they're toast. They're not saving you. They're not helping me at all up here with the prices above 60. I need the price to get above 60 before March. If it does, then I'm fine. If it falls below 60, then I'll be hurt badly. So March is really the timeline, the deadline for this to work for me. It's still 2 weeks to go, so this stock is really moving. So it could very easily get to 60 in 2 weeks. And if it ends up falling, then those 2 puts are going to protect me pretty well. If it falls in the first week, if we look all the way out 1 week, yeah, they'll protect it pretty good. I mean, better than just having straight up calls. Those will get hurt badly if the price falls. What you can do is try and spend less by getting out of the money stuff, but I mean, that has time decay problems. The at the money call, as long as it's at the money or in the money, it doesn't have much time decay on it. So if the price falls, I will want to reset this position at lower strikes, and it's to keep the time decay on the call that I'm long to a minimum, because that makes up the bulk of the position. So I want most of the time decay to be coming from the puts. All right, well, probably going to end it here. I'll try and do another one of these. Maybe I'll come in with a watch list, and we'll go through the watch list. There's lots of stocks making bases right now. I talked about NVIDIA this week. I didn't talk about it on the stream this evening, but maybe later in the weekend we'll talk about NVIDIA. So thanks for everybody for watching. If you liked it, give me a like, and if you really liked it, please subscribe. This is a pretty new channel, so all the help I can get for spreading the word on it, I appreciate. So thanks everybody. Good night.